The next point is understanding and managing tax implications. So what I've done in the first box there, I've listed the different tax rates you need to be aware of. Income tax, capital gains tax, dividend tax, tax on interest, inheritance tax, and some countries, like Spain, have another tax which you may not be aware of called wealth tax. In Spain, as an example, capital gains tax, dividend tax, and tax on interest, they're all merged together. So you could be a business owner, taking dividend tax, and then you've got capital gains tax on investments, and they fall under the same brackets, which means you end up paying more taxes. So you need to understand how these work in different countries and how it works for example, assets that are outside of the country as well, because Spain are going to take the withholding tax, and this is probably going to happen in a lot of other countries as well. The tax strategies I mentioned briefly at the beginning, finding out what the local products are. So that is definitely best done for a financial advisor. The second point is what funds or ETFs you decide to buy. So you've got two different types. You've got distribution funds, or it could be called income, and the second is accumulation. And the difference here is the distribution would pay out the interest and the dividends to your account, which means every time that's paid out, you're going to end up with a tax bill. Whereas accumulation funds or accumulation ETFs, they gross, they roll up the dividends and the interest within the fund, which doesn't incur taxes. So it just means your pot has your funds have the benefit of compound interest, which means your pot grows faster. Of course, you have more tax to pay at the end, but I'd rather pay more tax than pay more tax early on and end up having a reduced pot. Next point is diversification of vehicles. So this is well important now, especially considering what's happened in the UK budget. Everyone used to keep their pension pot as their biggest asset, whereas now the pension pot isn't actually that good of a vehicle. Compare it to the ISA or a GIA on death, it's probably the worst asset there is, because the ISA gets passed on, they all fall under inheritance tax, but then for general investment accounts, for example, those the gains rebase to zero. So you want to make sure it's diversified, because we never know, we're not going to know what the UK government's going to do again, or your local government is going to do. If they end up taxing massively on one vehicle, you want to spread that across to make sure that you're not going to get stung too badly by having all of your eggs in one basket. The domicile of your investment is really, really important. So this is, and it comes on to the next point, which is the importance of tax neutrality. So making sure your investments are in a tax neutral jurisdiction. I live in Spain. I don't invest my money in Spain. I keep it tax neutral. And tax neutral just refers to countries like the Isle of Man, Guernsey, Jersey, Ireland, Luxembourg, Cayman Islands, places where there's no inheritance tax, no withholding tax, no dividend tax, no tax of any sort, which means you only pay tax in the country where you're living. And that's so much better than having complications such as withholding tax or problems with probate on death and things like that. It just makes it a lot more cleaner. And it also gives the ability of having a global investment vehicle which you can take anywhere around the world. Because you could leave a country, and if you got an investment vehicle in that country and you're forced to close it down and pay taxes on those assets, that could have easily been avoided by investing your money in a tax neutral jurisdiction which is portable around the world. So all in all, it simplifies the cross-border element of things, which a lot of people don't think of, but it really, really is best avoided.